Fed Chair Jay Powell signaling that rates could actually stay higher for longer as inflation remains stubbornly high. So let's listen to what he had to say on that yesterday.
So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
So let's talk about that rate cut timing and what it could look like. Joining us now on that path forward, we want to bring in Lauren Baker, an economist with ITR Economics. Lauren, it's great to have you here. Thanks so much for joining us. So just give us your perspective in terms of Fed Chair Jay Powell saying, hey, maybe it would potentially make sense to wait a little bit longer for that first rate cut. What is your base case right now? And what does that ultimately mean here for the economy?
Well, the CPI result last week, and certainly his comments yesterday, did push back consensus a bit. We had been more confident in a June cut. I still think June is not off the table entirely. I don't think 3 rate cuts this year are entirely off the table, but the movement at this point is pushing back toward a September for being the timing of the first cut. We do have a lot of data coming still before that June meeting, so we'll see if March was just a blip or if that is more of a consistent trend.
What is it going to take to make not only the market, of course, but also the macro viewpoint kind of suffer from the amount of data that we're getting? And I understand that the commentary is now that this is bumpy and this is just the path towards disinflation. But when does that start to buckle? And when do we really start to say, yeah, June is just, it's not going to happen?
Well, I want to be absolutely clear. We are nowhere near the story of disinflation buckling. So even though that March number did come in slightly higher than expected, there was a tick up, especially in certain components, we are still well off those highs of CPI that we saw last year. So the disinflationary story is still very much intact. We never want to assume a trend out of just 1 month of data. But again, the path to 2% is what we're questioning. How long does it take to get there? I don't think we have to get to 2%. Jay Powell's been very clear on that. We don't need to reach 2% before the Fed begins cuts, but we do have to be moving, as he said, consistently in that direction.
What do you think is going to give them a bit more confidence? What level would you say? Not exactly, but just giving us a better idea. If it's not 2%, what do you think that range then potentially is?
I think what's more important even than the headline CPI number is the wage inflation data. So the Fed does want to see the labor market cool off. Wage inflation has been one very sticky aspect of inflation. We see a lot more cooling in, say, the goods side of the world than we do in the service sector. So service costs need to come down. Wages do need to cool off a bit. That's what's going to give the Fed more confidence that we're moving consistently in that direction, that cuts are merited.
And I know you know also that the U.S. consumer continues to be strong with the labor market, which, of course, is part of the Fed's dual mandate. And that's certainly part of the thinking there, Lauren. Thank you so much for joining us. Really appreciate it. That was Lauren Baker joining us to talk about what's next for the Fed.